Hi my dear students, here I present the topic partnership business and its basic accounting procedures. What is partnership business? Partnership business is a kind of business where an agreement between persons or two or more persons for running a business and agree to share the profit or losses that their business generates. In case of partnership business, two or more persons are there and their own agreement is there to form a business, and its own profit earned or loss arise in their own business shared by the partners or persons in their own ratio. Here, the persons ended in the partnership business is named as partners and collectively named as firm. Let's look at the definition. In India, it is regulated and conducted under the Indian Partnership Act 1932. The Indian Partnership Act 1932 defines partnership as the relation between persons who have agreed to share the profit of a business carried on by all or any one of them acting for all. Say, in this definition, it is clear that, say, more than one person is there to form a partnership business, and one agreement is that to form a business and to share the profit or loss arising in their own businesses. Let us look at the features of partnership business. So first feature is that number of members. I say the persons joined in the partnership firm, it is named as partners. So minimum number of members required to form a partnership is 2, and in maximum 10 in case of banking business and 20 in case of other businesses. Another is that agreement. I already says that the partnership is formed with an agreement between partners. It is oral or written, and the written agreement is named as partnership deed. Say business motive, that is another feature. The agreement of partnership is to carry some kind of business and should have a profit. Sharing of profit. In partnership business, it is formed with 2 or more persons, and their own purpose is to earn profit and must be shared by all partners in an agreed ratio. Another feature is that sharing of risk. More than one person is there in a partnership, so the risk of loss also shared among each partner. Unlimited liability. That is one drawback also in partnership business, because in partnership firm, the liability of partners is unlimited in nature. Have any debt arise in the partnership firm, that also bear by the partners, that is be named as their own liability is unlimited. Continuity. Say in case of death or retirement of any partner, the partnership will be dissolved. That will affect the existence of the partnership. For its continuation, the remaining partners must make a fresh agreement. Skillful effort. Unlike sole proprietorship business, the partnership firm has the advantage of knowledge, skill and experience of different partners. Here I mention sole proprietorship business. Have any limitation of sole proprietorship business? Yes. What are those limitations? Say it is formed by one man. That is a one-man business. He solely manages it, he solely controls it, he is only the recipient of profit, and have any loss, he only sustains it. So, unlike sole proprietorship business, in partnership business more than one is there or more than one person is there, that the advantage of knowledge and skillful effort of different partners. Next, partnership deed. That is one of the main important document of a partnership business, written document. Partnership deed is an important written agreement between all the partners of a firm. Let us look at the slide. what are those content of the partnership deed. It mentions some of those basic rules related to partnership deed that mentioned here, and you noted that in partnership deed it includes the terms and the conditions of partnership among the partners. That means it contains the rules and regulations governing the firm. And also it is noted that it is prudent and advisable to put the partnership agreement in writing in order to avoid dispute and misunderstanding in future. Let us look at this slide. Say what are those content of the partnership deed. One, name of the firm. Another is that name of partners, nature of business the partnership is conducted, the place in which the business is situated, and the amount of capital contributed by each partner. Then their own profit sharing ratio that also mentioned in the partnership deed, and amount permitted to be withdrawn by each partner that allowed by the partners to withdraw some money from their own contribution, and have any rate of return on capital and drawings that also mentioned in the partnership deed. Another is that mode of valuation of goodwill in case of admission, retirement, and death of a partner. Another important content is that the rights, duties, and the liabilities of partners also mentioned in the partnership deed. Then how to settle the account in case of dissolution of a firm. Another is that arrangement in case of a partner become insolvent. Next is that maintaining the accounts and arrangement of audit, etc. So those are the main terms and conditions which involved in the partnership deed. Here another point I explained what are those methods followed while preparing the capital accounts of partners. There are two methods. Say naturally in partnership business they prepare one trading account, trading and profit and loss account to find out their own profit. And additionally, they prepare one important accounts like a capital accounts of partners. Naturally, two methods are followed while preparing the capital accounts of partners. One is fluctuating capital method and another is fixed capital method. Now discuss about fluctuating capital method. Its own heading involved that fluctuating, which means vary. Say under fluctuating capital method, the partnership prepare only one capital account in each partner. Then what are those yearly adjustments? The yearly adjustments are done in the capital account itself. So suppose for example, in a partnership business, two partners are there. I give the name A and B. How many accounts prepare? Two accounts. That is A's capital account and B's capital account. In their own account, the capital account include the capital contribution and all yearly adjustments that are recorded in the capital account itself. That is a feature of fluctuating capital method. Then you noted that what are the yearly adjustments? Drawings, interest on drawings, then interest on capital, that is interest payable to the partners for the contribution made as capital. Then salary, suppose one partner acts as a full-time staff in the organization, in the business, to pay salary, the firm obligated to pay salary, and a share of net profit or loss. Then commission, that is another point. Suppose one partner acts as an agent, the firm liable to pay commission to the partner. So those are the yearly adjustments that made in the capital account itself. So we can say that the capital balance of partners at the end of the year will be different from that of the beginning of the year. Why? Because the yearly adjustments are made in the capital account. That is the reason. And another point you noted that while preparing the problem, have anything will increase the capital position of partners that will credited in the partner's capital account, and anything will decrease the capital position to debited in the partner's capital account. Now look at this slide. I gave one format of capital account under fluctuating capital method. That format record one partner's capital account. So in the debit side and the credit side, some of those items are recorded here. First item in the credit side, by balance brought down or by cash. That is the capital contributed by partners. What entry should be passed? In the firm's view, cash comes in. So the entry will be cash accounted debtor to capital. So in the capital account, that item is credited. And another I recorded by salary. From firm's view, it is an expense. That also due to the partner. The entry will be salary accounted debtor to partner's capital. So that is credited in the capital account by salary. And commission, if such a partner is an agent, to pay commission too. The entry will be commission account debtor to partner's capital. At that time, the commission is credited in the capital account. Another is that profit and loss, that I recorded in two sides, both these sides, because if it is a profit, share of profit, that credited in the capital account. And if it is a loss, that debited in the capital account. You noted in the slide. And another item, say debited, is that drawings. Why drawings account is debited? Because it make to reduce the capital position, that withdraw from the firm, from the capital. So have any item will decrease the capital position of a partner, that debited in the partner's capital account. So drawings automatically decrease the capital position. So that item is debited. And another is interest on drawings, that is charged to the drawings made by partner, that also debited. And again I say profit and loss account, here it is debited if it is a loss, that depend upon the problem and the position of the firm, and after that the account is balanced. In this account, say which shows a credit balance, and that is the closing balance of partner's capital account, and under fluctuating capital method, the closing balance of the partner will fluctuate or vary with the opening balance position of capital position of the partner. That is a feature of fluctuating capital method. Another method you noted, the next method is fixed capital method. What is the feature of fixed capital method? Fixed, that is constant in nature. So under fixed capital method, the firm prepare two accounts. That means two accounts are maintained for each partner. One is a capital account, another is a current account. Then again I say the example, two partners are there in a partnership business. Under fixed capital method, how many accounts prepared? 4 accounts. Suppose A and B are partners. A's capital account and one A's current account is prepared. B's capital account and B's current account is prepared. So here it is noted that under fixed capital method, we prepare 2 accounts for each partner. One is capital account and another is current account. The capital account is credited with the original capital contributed by the partner and any additional capital introduced, that only recorded in the capital account. And what about yearly adjustments? Those yearly adjustments are recorded in another account called a current account. I already say what are those yearly adjustments? Drawings, interest on drawings, interest on capital, salary, commission, etc. Okay, those are recorded in the current accounts. Hence, the capital account will continue to show the same balance from year to year, but the balance of current account will fluctuate time to time. Say at the end of the accounting year, current account should be balanced. If it shows a debit balance shown in the asset side of balance sheet, and if it is credit balance shown in the liability side of the balance sheet. So in short, there are 2 methods of preparing capital account. One is fluctuating capital method and another is fixed capital method. Under fluctuating capital method, only one capital account is prepared for each partner, and under fluctuating capital method, two accounts are prepared for each partner, that is capital account and a current account. Just I give the format of capital account under fixed capital method. You see the slide, partner's capital account. In the capital account I record only the opening balance or capital contributed by the partner, that is by cash, and if any additional also I record by cash, additional capital introduced. That only two items are recorded in the capital account. So capital is yearly base, it is fixed in nature. And you see the current account, all other adjustments, yearly adjustments are recorded in the current account. You noted that? Say the balance here, it is credit or debit. If it is credit, in the slide it shows as the credit balance, so that balance shown in the liability side of balance sheet. If it is in the debit balance, it is shown in the asset side of the balance sheet. These are the two format of current account and the capital account under the fixed capital method. Next, it is clear it with one practical problem. Here in this question, Arun and Varun commenced the business as partners on 1st January 2019. Here two partners are there, Arun and Varun. Arun and Varun contributed rupee 1,90,000 as their share of capital. They too contributed capital. And Varun, the second party, entitled to salary of rupee 15,000 per annum. Then the partners decided to share profit and losses in the ratio of 3:2. Partners entitled to interest on capital at 5% per annum. And they make drawings, the drawings of Arun and Varun for the year ended 31st December 2019 were rupee 10,000 and rupee 9,000 respectively. The profit of the firm was rupee 20,000, that are recorded in the bracket after making all adjustments, that otherwise called a net profit. Only net profit should be divided by the partners. Say the net profit that considered as after making all adjustment, that is after making all expenses and losses. Here I gave prepare capital account of partners under fluctuating capital method and fixed capital method. In the same question we apply for two methods. Just to look at the answer, fluctuating capital method. Under fluctuating capital method, here how many accounts prepared? Two accounts. What are those? Arun's capital account and Varun's capital account. Here in the slide I give the answer Arun's capital account. You noted that first I returned the cash capital contributed by the Arun by cash 1 lakh, and interest on capital, that is 5% on the capital contribution, that is 5,000, and a share of profit I divided into 3:2 ratio, that is 3/5 and 2/5. At that time Arun got 12,000 and Varun got 8,000. And in the capital account you noted that two drawings, because Arun withdraw 10,000 rupee in a year. In the year he withdraw 10,000 rupee. And here I balance this account. It's on closing balance shows that 1,07,000. Here you noted that, say in the beginning Arun introduced only rupee 1 lakh as capital, and his own capital position at the end shows that 1,07,000. That fluctuates, that vary. Why? Because all adjustments are made in the capital account itself. That is the feature of fluctuating capital method. Clear it? Then another, Varun's capital in the same way here prepared. Capital contributed, interest on capital, salary, then share of profit are credited in the Varun's capital account. I again say those items increase the capital position are credited in the capital account, and those reduce the capital position debited because drawings. He withdraw 9,000 from capital, that I debited here, and the balance here shows 1,08,500, and he introduced only 90,000. Have any difference? Yes. Why? Because the concern follow fluctuating capital method. Under fluctuating capital method, the Varun's capital also fluctuate. His own closing capital balance and the end vary with the opening capital balance. Then to apply the same question to fixed capital method. What is its own difference? Here also I prepare Arun's capital account. Under this method I prepare two accounts for Arun. What are those? Arun's capital account and Arun's current account. So in the Arun's capital account, here I record only the capital contribution. You noted that? By cash 1 lakh. It is fixed in nature. And those yearly adjustment I recorded in the Arun's current account. Say interest on capital, share of profit, and the drawings are recorded in the Arun's capital account. And another account of Arun's capital account, here also in the same way I prepared. His own capital contribution rupee 90,000 credited, that only recorded in the capital account, because under this method, under fixed capital method, say to prepare two accounts, Varun's capital account and Varun's current account. So in the Varun's capital account, here we record only capital. Then those yearly adjustments are recorded in the current account. You noted this slide? Varun's current account shows the balance 27,500 last. So all yearly adjustments like interest on capital, salary, share of profit are recorded in the current account. These are the difference between fixed capital method and fluctuating capital method of preparing capital account of partners. These are the basics of theory and practical or problem related to partnership business. With this, I conclude the topic. Here I explain the partnership business and its own related features, and one example that provided for preparing the basics of accounts. Those are recorded and prepared with one example, and I conclude my topic. Thank you.